Recording on this computer. Hello, everyone. My name is Sheen Trades, and I'm a co-founder of Traderlink. And today's class will be with Liquidose and Fatte, one of our few Apex traders. Not Apex funded, because that's gay. Shit, did I just say that out in the recording? Bleep that out.
Bloop, bloop.
But one of our few Apex traders anyway. With that being said, I'll let them take over. You guys can give yourselves a brief introduction. I know everyone kind of recognizes Fatte from Tuesday, but Liquidose, you can give yourself a brief introduction. I'm gonna go on mute now. Everyone enjoy.
I don't even know how to introduce myself. I am Liquidose. I think most people know me from the chat. My actual name is Steven, but I've been trading with these guys since fuck, it's almost been a year now. Nearing a year in a month since it was, Apex Capital back in the day. There's only 39 of us back in the chat. All we had was Gamma and Vanna.
Yeah,
corporate
simple
sponsorship.
time.
Yeah, the simple times. Before you needed another monitor. Fuck,
Yeah,
man.
right. Yeah, and I'm Fatty. You guys know me from Tuesday's class, probably sitting around Discord talking a lot of shit. Uh, but that's Geo was saying today on stream too. It's you got to kind of make this your own to develop your own strategies around it. That's where it's fun. Talk shit with your friends. Try to make some. Yeah. Today we are talking about dealer positioning, delta hedging, and volatility. Um, so basically, we wanted to kind of start with, uh, damn. So basically, we wanted to start as simple as possible with this. So I'm just going to go a little bit into dealer positioning. So indices dealers provide liquidity to the markets, and their main goal, right, is to remain delta neutral.
Actually, let's stay on this.
So they are looking to often offset their deltas that they take on from all of us who are typically, buying and or selling options. They are looking to take the other side, right? So for longer term options, they are going to typically hedge those. I'd say like 90% of the time, they're going to typically hedge those with shares. And then according to Jim Carson, um, they are most likely hedging their zero DTE options with more zero DTE options, zero DTE options. So if the dealer's goal is to always remain delta neutral, how are they making profits, right? So basically, what that comes down to is the spread. So for example, let's say they are short calls. Like let's say I buy, a call 100 call on a stock. They are going to then be short that option, which means that negative delta. So they offset that by buying shares. And so basically that profit that they are generating is going to consistently be the difference between the bid and ask of those contracts. And so as those deltas rise, for example, they're going to start selling shares into that to again or excuse me, buy more shares into that as their deltas on calls rise, on their sold calls rise, and if it were to go down, then wait, no, hold on, I'm totally backwards. All right, let me just go into an example, and it should be a lot easier. All right, so let's say an institution is short the 5,000 put strike a month out, let's say. Um, dealers are going to then buy those 5,000 puts, creating a negative delta for the dealer. Dealers will now hedge by buying the required SPY shares to offset that negative delta. So let's say, for example, that their put delta is minus 0.5, and the institution sold 100 of those options. The dealer, that dealer that is going to then create a negative delta of 5,000. So in order to offset that, they buy 5,000 shares of SPY. If we move down in price and the put deltas rise to 0.6, that negative delta on that position is now going to grow to negative 6,000, which means the dealer is now required to buy 1,000 shares. If we were to move up and that put position goes to a 0.4 delta, the new negative delta for that dealer is now 4,000. So the dealer will need to sell 1,000 SPY shares. Sorry for the jump. Hopefully that makes sense.
All right. And generally, I think the misconception about this sometimes is that they have to constantly rehedge and hedge these shares throughout the day, and generally they have a kind of a larger option kind of spread already set in place. That's kind of like a barrier in between. And like Fatty was saying already with the zero DTEs, sometimes if the gamma is much stronger, they might have to, add in some other options. But usually they have some leeway. So that's why sometimes we'll see when we hit larger top of a range or the bottom of a range, we will see kind of like a giant rehedge or of their position, and it's because they create kind of like I said a giant spread already that gives them some leeway. And no, we go off of that, but usually that's kind of what we see sometimes. But there is not just a single market maker. Something to keep in mind. There is a lot of institutions using this same fucking tactic. They're all delta hedging, so it can get kind of chaotic.
Yeah,
It's a lot.
it can definitely get pretty chaotic.
Yeah.
So
Not
sorry,
be
go ahead.
seeing an option. I'm sorry. Is the level we may or may not be seeing on the option chain in the free market? I think sometimes, yeah, BK32. That is sometimes what we're seeing in the free market is them already creating the position to kind of hedge for the day, and that's I'll go into that a little bit later, volatility. And yes, Tom G, I'll share the slides because they're just pictures from online and also from a book. The book's available in the Discord by Benet. I think it's just called Trading Volatility.
Yeah, so for like a zero DTE example, right? Say the gentleman named Geo were to buy 150-60 zero DTE puts, and they have a delta of negative 0.12. The dealer's delta on that position is going to be positive 1,200 since they are selling those puts to Geo. So they're going to hedge that basically with an equivalent of a negative delta of 1,200. However, since it is so close to expiration, I'm kind of just using delta as a placement so that it's a little bit easier to understand. But for the most part, on the zero DTEs, at least according to Gem, one of the main thing that they are hedging is their gamma risk. So it's the exact same type of concept, but trying to keep themselves almost like a gamma neutral versus a delta neutral.
Yeah. So I guess we can hop into the next thing. It's just this little dealer position chart that I've created, which shows the initial investor buying of either a short call or a long call, and what a dealer will do when that happens. As you can see, when someone buys a call or buys a put, the dealer takes the opposite position. So let's just start with the call. If someone buys a call, they're going to be long delta and they're going to be long gamma, and then the dealer is going to be short the call and they're going to be short delta and they're going to be short gamma. As you can see, it's about the same for calls. It'll just be flipped. But if someone buys a put, they become short delta and they become long gamma, and then the dealer is long delta and short gamma. And then obviously on the flip side, But then with like we were saying earlier, the dealer hedge, which is the initial dealer hedge, I'm not sure if people can see this writing.
Yeah, it's clear.
Yeah, when I'm drawing on the screen, I'm not sure if it's actually showing. I think it just
Oh, right.
shares the slide, but their action is to, right, if they're selling calls to someone, they're buying, and then if someone's selling calls to them, then they are selling. So that's them, selling delta, or buying delta, right? To offset the, the negative or positive positions. And likewise, if they are buying puts, they are going to sell against them. And then if they are, geez, what's my phone doing? Okay, cancel that. And then if they are buying puts from someone, they are going to buy delta, right? Gamma will go into a little, I guess, more next time because it'll build off this, but you can see that. And then at the end of their cycle, they're going to essentially just dump those hedges. I know some people know what charm is. And if you're wondering at all, this hedge at expiration is essentially charm. We'll keep that to a minimum right now, but that's essentially what the charm effect is.
Yeah, I mean, honestly, today was a pretty darn good example of it. And
Yeah.
Gio even mentioned it on stream, saying in the last 15 minutes when all that charm falls off, where's it going to go? And up was the answer, which he anticipated. What an hour, literally just by seeing how big that. But so with all of the dealer positioning in mind, right, it would be pretty helpful if we were able to get a sneak peek into what the dealer's book actually looked like, or what the overall dealer's books look like, since Liquid has mentioned there's obviously a lot more than just one market maker. And so that brings us to DDOI, which is one of the tools that we all have on the Traderlink on the Traderlink dashboard. And I actually just added a slide, Liquid, if you want. Oh, all right, that works too.
Yeah, let's do this.
Yeah. So basically, it's going to show us the dealer positioning, and what you'll notice on most days is that the majority of that dealers positioning are wrong. Basically, showing that most funds and institutions are typically selling options because that is where and if they're playing the long game, that is where the majority of the money is made. So the positions that I tend to pay closer attention to are going to be those downward facing strikes. Today, there weren't really any close enough to spot, in my opinion, to take any of that into account. And so another way that we can utilize the DDOI is by looking at the distribution of it, seeing how it curves for the most part, seeing the skew, right, of that DDOI.
All right. Look at the skew like this.
Yeah.
And obviously, like we were saying, hedge-wise, especially with both sides, you can kind of tell sometimes that one might be more skewed than the other. One might be more wider than the other, like puts have a wider distribution as opposed to calls, which are kind of a tighter distribution. It's more volatility in the calls at that point. And puts are a little more wider, so it's actually giving more of a cushion to push the price up. Alejandro, stop.
I know that's you.
God.
All right, where does the point where the two skews on DDOI have significance? So on a day like today, what I would be basically looking for, right, is to see where the largest bars are of DDOI. Everybody kind of has their own way to interpret this and look at this, which is why I love this dashboard so much and these tools so much, is because everyone's going to get a little bit of something different out of it, right? So there was a time Liquid was kind of like taking the average, I believe, of the two largest strikes, um, and like putting like an X through them, and he was figuring out where close was
Yeah.
for a while. There's a million ways to skin the cat.
It was kind of like this since people were asking for a while. Some days,
Yeah,
on
so that would
less
be
volatile days,
honestly
it
that's
would
right
come
around
in.
50.75.
Yeah.
But so like for today, I would see, we have another tool that we like to use where that was showing 75 as well. But then you also see that large put strike where they are 50-50. And I would almost kind of be able to use that as a support. And then you can also look at the 50-90, I believe that is call side, as a bit of a resistance. Where did we reject first thing in the morning? 95, because we couldn't really push over it. We then used that 50 zone as a support. We bounced it 10 points away from 60. Then late in the day, when all that charm did finally fall off, it was able to push us over the I guess the hump there, 90. And then one of the things that I do really like to use it for is the smoothness of the skew, right? So you can see at 5100 to 5105, there's a decent sized drop off, and then after 5105, it's almost completely gone. So there was no real momentum to push us past that 5105, which was our exact high of the day. But again, that this is happens to be a great example. Is it always going to work like that? No. Exactly, Willie. There's just not liquidity up there, so there's no real reason for market makers to take us up there. They didn't have to hedge any positions up there because it was so.
Yeah, unless there's other institutions or other things happening, we have seen the price go very far outside here. It is kind of a rare occurrence, and it's usually when we squeeze very hard or when there's a lot of selling, we might go way outside the put. But generally, in the most part, we do kind of stay inside this big distribution. And if you do them together, you can kind of see it's almost like a standard distribution, right? So would that be a way to see more speed on the upside with calls due to volatility? Uh, I mean, that depends. Tom Rainey. This is 0DTDA. Matt, yeah. I think, yeah, I just have this. This is actually tomorrow's data.
I would say the reason we saw more speed to the upside didn't actually have to do with volatility, but more to do with how large the gamma at 5100 was for today, right?
Yeah.
So since speed is the gamma, the larger the gamma that sat there is going to be, the larger the speed that sat there is going to be. And one of the things this isn't really a speed class, but one of the things I like to look for speed is where and when we are not in OPEX week, is where the largest split strike is. That also generally lines up with the largest split strike of gamma, which today, even when we were down 50, 60, 5100, still the largest split strike.
And also considering this is tomorrow's data we're looking at right now, you can tell it's still very large. So all that built up gamma at 5100 was also for tomorrow. I could probably actually flip this to next week's data as well, and it'll probably still be the same. So those positions are not just for this week or for the day. It's going out several days. So let's see if I even go to the next Friday for a week out. See, 5100 is absolutely stacked with positions. So that's why it probably acts much more as the magnet today than we are used to. How do I know if the spread gap at DDY is support and doesn't start dumping at 50-50?
I mean, there's multiple things you can look at for that money. One
I
would
mean,
be,
yeah, you'd probably want to use the other
yeah,
exposures
yeah.
in
Like I
line.
wouldn't
Yeah.
exactly. I wouldn't use DDOIs at, like on its own. It's just kind of like a neat little tool to be able to see, get a little peek into the book of the dealers, right? Like, which is kind of the whole point of this class, right? It's what what do dealers have to do for the day? And so if we know what positions they are long or short, we can kind of anticipate the type of hedging will be required by and where they will push price around.
And also, it's something that is kind of interesting to always notice. I think let's go back to just today, tomorrow's data. I think, oh yeah, since DDOI hasn't updated, but a lot of times you can see these points on DDOI. You know, I think this is 5100. You can see if they are more stacked as opposed to, not as strong on gamma, right? And you can usually line up other things along, with this. You can see them maybe on Vana as well. 51. I remember 5100 was quite strong.
Mm-hmm. It was huge
Yeah, throughout
through
the
most
day.
of the day until the exact end of the day, right when that charm started to fall off.
I want to get into the relation between raw gamma bar and delta just gamma bar, or is that just for later? We'll save gamma for the next one. I got some stuff on volatility that might be more, yeah. In what situations speed the most effective in correlation to other exposures? During OPEX week, Lenny. That's we call it speed week for a reason. Purdue, the more balanced we are both sides, the more chop we'll see. Can you repeat the comment about a wider skew versus a shorter skew? Uh, I mean, you mean the entire distribution or just each side? Yeah, exactly. I mean, it honestly depends on the other exposures generally. I think today we actually ended up. I didn't record it. I should have. It would have been good to go over.
Yeah, I mean, I'm gonna try.
But generally, yeah, you want to use the other exposures and maybe DDoI as the kind of check everything else. All right, let's get back to this. Oop, slideshow. We'll do that in one of the next classes. Glenny got a whole one on exposures and everything. We're gonna kind of build into it. So basically, I know we were talking about DDoI, how to use it. We're going to talk about real quick how dealers do hedge, and generally, you can imagine if they are on a giant curve, right? The position, it actually might be more flat like this. So if they actually reach the edge over here, they are going to have to hedge, to push themselves back over, or if you get too high, they might have to hedge themselves to push back down. I know this is kind of a weird example right here, but right, if they keep going, too far one direction, they gotta level the boat out, right? It gets too heavy over here, they gotta add some more weight over here. Basically, in general, I know some people may know that, but not sure what the next ones are. Intel. And here's a better probably example. Like the same thing I was saying, if their giant curve went too far over this way, they're gonna have to rebalance over here. And then if it went too far over here, they're gonna have to rebalance over here. But like I said, they probably have, walls at certain points. And I know generally the risk profile is more shaped like this, so it's not exactly curved. So they might hit a point over here, at which point they'd have to push the price that way. Or if they hit the edge of this, they'd have to push the price this way. And this is just delta. As soon as we start getting into volatility, it gets a little more complicated, which I might have to get into here. So let's see. I don't know what the next slide is. It's
You.
about the same thing.
Mm.
All right, so volatility. I think some people have a weird definition of what IV is, implied volatility, right? During the day. Wait, let's see if I actually got the picture on here. Okay, during the day, if people use Thinkorswim, I don't know if anybody's ever noticed this. In the corner, you actually get the implied volatility right here of the entire stock. All right, and this is what the market maker has priced in for the day of what the move can be. And it actually shows you on Thinkorswim what the number is. So for tomorrow, we might go up or down $25. And some days that might just mean we're stuck in a $16 range, right? Or it might mean we actually might go up $25, or we might actually just go down $25. And I know that's kind of convoluted, but in some way it gives you an edge, right? If we're expecting $25 of a move and we go up, I have no idea what the calculated or specifically some kind of aggregate. Wait, where can I find that in TOS? This is the top right of the option chain. Would you know if that? I think on SPX, I think one standard deviation is about 15%. And as you can see right here, this is 13. I could be wrong. I'd have to double check that. I think 15 or 16% is a standard deviation on SPX.
16 would make sense because of the rule of 16, but I could be wrong. All right. Yeah, right. So another way to look at volatility, it's essentially the expectation of the market makers to see how large that the market is going to make, right? So they're trying to price those contracts accordingly in order for them to continuously, make money off of that spread that we were talking about throughout the day. And depending on where we are in terms of those edges that Liquid was talking about, they will have to buy or sell more of that volatility in order to remain delta neutral. Definitely a super simplified way of describing the relationship between delta neutrality and volatility, but we're trying to start somewhere and start on the more simple side of things.
So, and also, I'll go back a little bit here. So this is essentially, we're talking in the bathroom. Yeah, Fatty's in the bathroom. He's pulling a scone on us.
I was just about to say, yeah, what's going on?
So if this down here is the price of the underline, this would be the implied volatility right here, and this line right here is the price of the stock, and in between right here and right here is implied volatility. And that's why if people ever see things about why people sell volatility so much, it's because generally it is very overpriced, you know, a very high price in between. I didn't mean to delete everything there. I think it changes throughout the day for the plus or minus, but you can keep calculating it. It's based off usually the open, and then throughout the day it'll change. Like for the end of today, if you look at it, it's only about $4, but for tomorrow it says 25. And generally, I don't know if people know these terms. Volatility is based off the intrinsic value, and that is, the time value, and then also like we were saying, the IV. So this is what volatility sellers are selling you. They're selling you time, and they're selling you like a possibility of a large move, from what is this, $7 to $17. That's why that's why there's so much suppression sometimes. Let's see if we got some other stuff. Time is why it gets narrow as time goes on. Yeah, exactly. Also, as the day goes on, there's less of a chance that the stock's gonna go up more, right? Unless we see like a big event, the band gets smaller and smaller, right? The beginning of the day, it's larger because you have more time, and there's more chance that it can go like way up.
Yep. So this is why FOMC days, you'll notice that contracts are significantly more expensive before FOMC, just because market makers are anticipating a much larger move, and so it is going to cost you more
Oops.
money in order to, profit off of that move. They are trying to basically hold on to as much of that profit or as much of that possible move as they can as they price that up.
Oops. Going backwards my slides here. So, and also, with IV, it's not, from my understanding, the dashboard is refreshed real time, so it should reflect increased volatility institution positioning during pre-market events like CPI. That is correct, Constantine. It's constantly refreshed. It's about every 10 or 15 seconds, I think. Pre-market, it's not updating, but after open, you'll see it. Something like, especially on CPI days, a misconception is that the volatility is so high because there are a lot of people betting on something. It's more like that there's people or market makers setting the volatility so high because they're expecting that many buyers, or it's an agreement between two parties that the volatility should be that high, right? It's not. It doesn't mean there are a lot of buyers per se, which is kind of something that you know you'll hear on CNBC or something like that. Or it could even mean, yes, exactly, Matt, a lack of market liquidity, because it's possibly just one or two people that have sold contracts back and forth, and they've set the volatility so high because they agreed for it to be that high, right? I mean, you see it on penny stocks. If anybody's into doing that, or if anybody knows about that, that's exactly what happens on those. So it doesn't necessarily always mean there's a lot of buyers. Generally, sometimes it can mean the exact opposite.
Yeah, it can also mean that, for the most part, volatility is going to be high when
Oops.
there is a possibility of a larger gap, right? So if our average IB for the day is significantly higher, that means, protection is more expensive, basically. And market makers are anticipating a potential to see a large drop, and so rather than sell you that possibility at a cheap price, they're going to sell that to you at a high price because, like let's say put $30 out of money is going to cost you, $10 or something per contract. That we would then have to move $40 just for that to gain back its intrinsic value, right? So they are trying to take the money that would normally be yours, you would normally see in price appreciation on that put option, and hold on to it for themselves.
Exactly. Also, exactly what Willie just said. It's the market makers or dealers, whoever's already bought these options very far ahead of time, has been sitting on them for, I don't know, months, and they know the date's coming, and they just rack up the volatility because they know they can just turn up the price and people will buy them because they want the protection, or they want to play the upside of an event, or they want the protection for the downside. It's exactly what's happening. It's like if anybody's seen the thing about Wendy's recently doing the surge pricing, or even Uber, or how that works. It's like someone going into a Wendy's right before the surge comes in, and they just bought 100 baconators. They wait till dinner time, and all the people show up, and they just start selling them outside to undercut Wendy's and make all the make all the money, right? Because taking advantage of the mob mentality. Exactly. They know there's a demand, or that they're taking advantage of it, because they got the supply. Yeah, they create the IV themselves. That's a great way to put it. Yes.
Let's see.
Oops. Curious what other slides. I think that was the last slide I
That's it.
had. Yeah.
Yeah.
Sounds like a politician. Sounds like white collar crime, Tom Rainey. The Baconator mob. Also, I guess when we think of the volatility curve. I know this is for the day, but some days we see kind of like this curve in it, right? Actually, yeah, it might be more like this, going down. If this is like the put side, sometimes this is higher just because people are getting paid more to take on the tail risk. Right. They're getting paid more, or the market makers paying them to hold on to their puts or take their puts from them. Essentially, it's like a extra bonus. Someone wants to buy them or sell them. Why would vol be highest after option expiry? There would. Can you rephrase that, Matt?
Yeah. I was thinking the same thing.
Yeah.
I mean, I think the graphic that we have up right now is basically trying to show that this on the bottom is actually time.
Yeah.
So it's
This is.
showing that volatility is highest at the open and then highest again at the close. So during the midday lunch, when majority of Wall Street takes their 2 hour booze lunch break, uh, there's not going to be as much movement in the markets, which is actually why I used to follow opening a position between 12 to 1. Markets have changed a little bit in the last couple of weeks, so I follow that strictly. Uh, and there's been some decent moves, like right after lunch is over or even during lunch. But this is just a good example of like this isn't actually the volatility that we see on our game charts throughout the day.
Actually,
This is showing time rather than across strikes.
I don't have a picture of a vol curve, unfortunately. I thought I did. I was just using that as an example.
Oh no, I know,
Yeah.
but I was thinking maybe
Yeah.
that's why he's getting confused as far as volatility being highest. Yeah,
Yeah.
like
So,
after they're closed.
yeah. I mean that generally is what I'm talking about. Like trading after the IVDK post lunch. Yeah. Are the diagrams? No. Some of these diagrams are from. It's called Trading Volatility by. I think it's Benet. I think it's a French name, or Bennett. It's actually, I believe it's in the books or the education section in the Discord. I can find it and link it after we're done here. Yeah, it is. I mean this one, these right here, these are all from the book. Let me get off that. And it's a good book. It's a little easier to read than Nattenberg or some of the other ones, in my opinion. There are sections you can skip, obviously, but I think a lot of it explains itself well. All right, does anybody have questions? I'm curious. Any extras or? Here, I'll find it right now, Farmer Toast. I think it's kind of in a. Maybe it's not. Oh, Zoom's kind of blocking me from doing this. Here we go. Oh, thank you, Johnny. How you play the expected move with your gamma levels? Well, if you can actually look up. Actually, let's see if I can find this. If you ever. Oh, my chat thing died. There's this website called. I'll link it right here. Called VLab, and it shows. Excuse me. It'll show the volatility for the day, average volatility, the min vol, the average week vol, 1 week period, 1 month period, and you can use these as probabilities. You kind of have to do a little calculation to. I think you generally take the 1 week period. I think there are other websites that might do this a little better. But this is just using what's called a Garsh volatility model. And in general, you can use this as a probability to calculate where the price range will be and how, I guess, how big the probability or how low the probability your option will end in the money or out of the money. That's kind of, and I know someone else in another Discord that literally just uses probabilities to play options, and they are quite good. They're like a hedge fund. They work for not generally a hedge fund, but they outsource what they do to hedge funds. They give them like a strategy. Can you discuss how American options works? It matters how much they move over the strike price, right? Not just that they're hit within the time frame. Matt, I think it depends on the broker. I think during a certain time of day, I think it's after 2 or 3, if you're in the money or you can be exercised depending on your broker, they might just sell it or buy it from you. I don't really play American options because of the risk. I generally like to play European options. Maybe someone else might be able to help you with that.
Yeah, I mean we can definitely utilize the dashboard to play. Like you can utilize it to play SPY. You can utilize it for like Nvidia, Tesla, Google, Amazon, Apple, all the bigger names, stuff like that, which is going to be the American style. Uh, but for the majority of my trading advice is solely on SPX. Uh,
Yeah.
as far as it matters strike price, not just that they're time frame. I mean, it's going to be somewhat similar uh, to how SPX moves, right? It's actually going to probably appreciate just a little bit more because there's extra risk involved in holding them. Um, almost through to expiration or through to expiration because you have to just go exercise. But I guess I'm not fully understanding the question.
Yeah. I mean, anything that's not SPX, NDX, and I think a few other indices. There might be one other one, are European options, which are not exercised, so you don't have to worry about them. But you can use all this data for, yeah, well, anything that's cash settled. But if you're playing, options on, yeah, I mean, besides
Yes,
IWM,
QQQ and SPY.
yeah.
Spread.
Oh, that's awesome, Kings.
Uh, yeah, farmer toes. That's just basically what the dealer's requirements are based on what the deltas of the options that they have sold or bought, and it corresponds to the deltas, right? So I don't know if you can hear me now, but basically, if a dealer were to sell a put, or excuse me, buy a put that an institution is selling, they are going to have a negative delta because they are long puts. And so if they have a negative delta, they would then have to offset that with a positive delta. So they offset that with these equal amount of delta in shares.
So pretty much 5,000 shares would equal negative, right? 500. Or just basically, if it was just, you know, one delta is negative 100 shares. God, this thing's kind of jumpy with writing.
Yeah, hopefully that makes sense.
So what I am learning for SPX to trade ES may not always apply to QQQ to trade NQ. Those are ES and NQ are futures. So they do not have gamma, and they don't have. They are actually ES and NQ are used as ES is used to hedge SPX, and NDX is used to hedge NQ, or NQ is used to hedge NQ
QQQ.
or QQQ.
Yeah. Or NDX if people are getting
Yeah, I think
spicy.
yeah, that's what I trade. They mirror the options market. Yeah, Matt. I mean, they're just
Yeah,
essentially fields.
yeah.
Shut
I
up.
mean, you can definitely trade ES off of the SPX levels. You just have to account for what the difference is.
Yeah, you can exactly. You can still use gamma for those. They definitely mirror. Like I know Nancy Pelosi's Alejandro. If you volatility, you prefer seeing the IV and the option chains, or do you prefer VIX? I'd use IV on the option chain as opposed to VIX, because VIX is a for the entire month. I think it's every
Yeah, it's
second Friday mixed into a monthly percentage.
like future 30 days out, 27 days, 32 days, something like that.
Let's see if I
Yeah, exactly, man.
does it actually say.
By second.
Yeah, let's see. Future implied volatility for 30 days out. I mean, it's good to have on a chart. It's nice, but sometimes it can be deceiving. But like someone said, they were going to post something in the Discord for calculating the volatility for the day. It might be good to get into doing that, or you could use what's built into TOS. I know there's one in IBKR as well. I think every broker has one. And you can generally just base it off that. You know, sometimes the move does get bigger. If there's an event later in the day, it might change. It's always something to keep in mind. But on, just vanilla days, it's you can use it to calculate the range to some degree. I think the first 2 days of this past week, it was around 25-point range, and we were stuck in, I think, at like a 16-point range for 2 days straight. But figure 133. What's figure 133?
Slide 6.
Oh, slide 6. Oh, this.
Yeah.
So this is for delta hedging skew. It might be a little more complicated to try to explain. But this is the volatility curve, right? Like as it goes this way, they I think this is for hedging Vega. And so Vega hedging is kind of mirrors gamma hedging in a way. Like as it goes down, they're gonna have to buy the underlying. As it goes up, they're gonna have to sell. It's kind of mirroring a positive gamma environment to maintain like the volatility curve, from getting too out of hand. It's kind of, honestly, it's just this. It's shown as an S, but it's really this. It's kind of actually shown. This is what Vana looks like in a way, but really it's just this. Like I said, it's like a weight, right? The weight gets too heavy on this side. I got to put more weight on this side. They keep it, keep it from falling too hard this way, right? They don't want this flat. Because if this gets flat, then there's a lot to hedge this way. Does that kind of answer your question, Farmer Toes? Cards today's with 5,100 short dealer position. I honestly wasn't using the dashboard too much today. Like, I just knew towards the end of the day there was a lot of positive, negative Vana. Actually, it was a lot of negative, and it started to slowly become positive, so it kind of turned into a magnet. So we got closer and closer. If you watch Gio's video, I think he was doing it live, so he's probably a little more into it.
Yeah, he goes over it with Charm as well. But I mean, one kind of easy way to look at the 5100 position is if they are short those calls there and the deltas begin rising as they slowly rise. Well, yeah, as those
Yeah, as we got closer and closer, I'm not sure if you got cut out. So got closer and closer to the 5100. Their negative delta started going up. As their negative delta started going up, they had to start buying
yeah,
positive delta, right? So as the price gets closer and closer, this number goes from, 50 to 100. When it hits 100, it's like maxed out, and then the price is just going to go flying towards it.
yeah.
If that makes sense.
And
That's
then
usually what happens in a squeeze, when we see short squeezes.
once we were over it, can't rise. We hit it. We overshoot by a tad bit, but then their deltas are all it's 1-to-1. Now it's free to basically sell it.
Exactly, yeah. That's why once we made it over, right, that negative one delta maxed out, we hit the top over it. This entire position sold out, and that's why the price just dropped.
Yeah.
That's
They buy back all the short calls and they sell the shares.
So we were able to clear the delta maxed out so actually here this chart right here is a good example. Look, if they were a lot of bot calls and the dealer was short the calls, right? They had to keep buying, right? As we got closer, when they hit in the money, they had to keep buying. But once they expired, kind of close to the end of the day, they sold them. Yeah, so yeah, I'll share this chart. Yeah. And this is what we've seen on OPEX. We've seen this happen. It's like this exact thing. I think this happened during not last month, but the month before, where we squoze the entire day, like 60 points. It's almost the same thing. I think it was a lot of sold puts. Got stuck. They were all out the money. And as they began to expire, they had to buy. But that's why I remember Gio was like the next week, he's like, I'm going to go really, really short because, they have to sell them after.
It's all going to fall off. Yep.
Yeah.
Word. Well,
It has been an hour. Anyone else have can you explain why dealer sells out the money is hedge all right. So if the dealer has been sold a lot of calls, right? They're short delta, and the calls are out the money. As charm starts to kick in, the delta is beginning going to slowly go to zero. And as it goes to zero, let me have that backwards. Oh wait, because they're going to have positive delta. Sorry, and they're out the money, right? They're out the money calls. They're going to go down. The price of them is going to go down. The delta value is going to drop. As the delta value drops,
longer to hold the shares down.
actually, yeah, this is actually supposed to be negative. Yeah, because they're going to. Oh. I have that right?
Are you talking about for? Wait.
Hold on a second.
Sell that.
I mean, it's generally charm. So wait, okay, so they're positive delta, and as they go to 0,
Are you talking about sold puts or sold calls?
it's deal or short calls.
Then that would be.
I actually took this from someone, so I'm not sure if they had this right.
No, I'm pretty sure it's right.
Yeah,
Just trying to work it out
yeah,
before saying anything down.
exactly. It's been a long day for me. But what are the one of the best times to look at charm exposure? The end of day or on OPEX week? But Glenny, it's because they're it's just the charm exposure. It's you know, if something is at 50 delta or, you know, less than 50 delta, it's going to go to 0, right? At some point. And their positive hedge against this is going to get sold off. It's essentially what happens. On gamma pinning, we'll cover that in the next one. Next one, we'll go over a lot of gamma stuff. Just because we're already running an hour here. You said the best times. End of day, like power hour, yes, Lobes. That's exactly what happened today. Was, you know, right here at power hour. Where's power hour? This right here. Look, this is. It literally was right there. The beginning of power hour.
Yeah, and then you can.
Was the squeeze, and this was
Yeah.
the end of the day. So if you were watching Charm, you could catch that. This giant parabolic move. There's people that use it for other tickers. They have to generally have to be more liquid lobes. I know. I think Rizzy uses for Tesla, for Apple, for other ones. I know people have had success from SPX. It kind of reads out the entire thing for you. I'll cover that more in another class, Glenny. But generally, yeah, the overall number for charm, it's like the number in the corner. Let's see if I still have the dashboard open here. I don't think I do. Yeah, exactly, Johnny. Yeah. Yeah, but BK32, yeah, the overall number, anything over like 300 billion's high. If it's over 500, it's pay attention to it. At OPEX in February, or not February, I think it was January. There was negative 800 billion, and the entire day was just a giant squeeze.
Just a fucking stop squeeze. Yeah. All right. Well, thanks for tuning in, everybody. We're just over the hour mark, so we're probably gonna call it here. Hopefully, you guys took something from this class. If not, let's hang out on Discord. And I believe you're gonna be hosting these, getting a little bit deeper on future Tuesdays and Thursdays. So come back and hang out with us more.
Yeah. Next week we will do Gamma and Vanna, and we'll go a little deeper into it. And then the following week we will go deeper into other exposures like Charm, Speed, Voma, possibly Zoma, Lambda, because I know somebody was asking about that as well.
Yep.
Yeah, well, Fatty's about to get a house, so he'll have some Ultima actually useless interest.
All
If
right,
not,
once again. Oh, sorry to cut you guys off.
no worries.
No, you're good. You're good.
I heard some goodbyes, so I was just like, okay,
Yeah.
I should probably. But anyways, thank you guys for tuning in. Thank you to Fatty and Liquidose for running the class. And I believe, as they just said, we'll also have they'll be doing classes next week as well on Tuesday and Thursday. And then I think that's it for, I guess, the session, right? And then I'll hop back in, do some, and then you guys will repeat that cycle, I guess.
Yeah.
I'm assuming. Okay, perfect then.
Yeah.
That's the plan.
With that being said, thank you guys for tuning in. And we will see you guys on, or Gio will see you guys on stream tomorrow. So goodbye, everybody. I'll upload the class as soon as it's done processing. Everyone have a great rest of your guys' night.
Have a good night, everybody.
Later, y'all.